Welcome to the 13th grade. My name is Elliot Schoner. Today, I want to talk to you about lending, more specifically, how banks make their money, how they lose money. If we understand both of those, it'll let us understand what we need to do to ensure we get an approval at the best interest rates and the best terms. Let's dive in. All right, guys, thank you. Welcome back here to the 13th grade. So we just talked about a bunch of things. I'm not going to go over all of them. If you have not gone and watched the previous lessons, I'm going to say this every single video practically. You need to go back and watch the beginning part. I know it might be very, very enticing to go in and say, oh, I just want to learn just this one section. If you've already gone through the course, you want to go back and review something, very, very good to do that. However, all of this stuff sort of builds on each other. These things are very, very complex, and they're just going to get more and more and more complex. This is actually why in some of the videos I go back and I'll just sort of regurgitate what we've already covered, because I want you to hear it several times in multiple different ways. So we're kind of going forward and backward and forward and backward and forward and backward, but we're still progressing down a pathway. If you have not watched the stuff on credit, how to and so forth, you need to go do that, understand what's in your credit report and all that kind of stuff before you get to lending. And then after this, we're going to talk about how to actually build that credit scores of what the lenders will love. However, before we do that, I want to discuss with you exactly how lenders make money and how they don't make money. If we understand that, then we can understand what we need then to do to show them that we are going to be a good risk for them, and that we're going to cause them to make money, not lose it. And if we can do that, that means more approvals, better terms, and so forth. Okay, so without further ado, this is Lending 101. Oh, and I'll just say to you that, again, this is going to be a 30,000 foot view. So if we're going through this and you're like, man, you're really this is not like very, very super detailed, there's a reason for that. My business, my industry that I was in for nearly, I don't know, 15 years or so, was building specifically into the financial markets and dealing with all different types of loan products, helping people get financing, helping people build credit, and all of that kind of stuff. So I can assure you that I know the granular details of all the different loan products out there, how lenders work, how banks work, all that kind of stuff. I'm not going to go over that. We probably will do an expanded version of this particular area later on down the road. But I'm not going to do it here because, again, we're already at like we'll be at thousands of slides, and I'm trying to respect your time. So first thing we want to talk about is the simple one. How do lenders actually make money? And this may sound super basic, but it's very important that you understand how lenders make money and, again, how they lose money. So how do they make money? The most obvious one is they're going to be making money off of the interest rate that they charge you. Okay. But I want you to understand the intricacies of that, because it's not just like completely straightforward. If a bank, let's say you go to a bank and you're like, I need a $10,000 loan. I want to, build a deck in the backyard, for example. Okay. So you go in, you apply, you get a $10,000 loan. And let's say they give that to you at a 5% interest rate. So that bank is making $500 off of the 10,000. Now, banks will charge you different types of interest rates based on the loan terms that there are. So credit cards, there's like daily interest, there's simplest annual interest, there's different types of loan products. Again, we're not going to go into those. For the basic, just so you can get it into your mind, just understand, in the exact same way, if you took 10,000 and you put it into the stock market, and let's say you wanted a 5% return, you would be getting, $500 back, from that every single year. You also, like a bank, if they lend you 10,000 and they charge you 5% interest rate, they're getting $500. Okay. So that is their profit. That's the money they're making off of that. So banks make money off of the interest rates. Some loans are, 4%. Some loans are 25%. We're going to get to that in a second, why that actually is. The other way banks can make money is off things like annual fees. So a credit card company, for example, might have an annual fee of, say, $95. They might have an $800 one. Actually, there's some credit card companies out there that have annual fees in the thousands of dollars. Again, we'll get into that in a little bit. And then they also make money off late fees. And I think we all get that. We've all stumbled. I can tell you, I've paid my fair share of late fees, unfortunately. The interesting thought thing that I learned, but I didn't necessarily understand before I got into the financial industry, is that late fees aren't necessarily there to penalize you in the way that you're thinking. Believe it or not, late fees are designed to keep you motivated to make your payment by a certain period of time. Without late fees, then you really wouldn't have a tangible sort of thing there to understand like that, your balance is still going up. You didn't make a minimum payment, so you didn't at least pay the interest. Your balance went up, but like you just wouldn't be motivated. So let's say you have, a $5,000 credit card, and let's say your payment is, I don't know, $500 a month or something. Most of that's probably going to interest. Let's say $350 is going to interest, 150 is going to your principal. If you just didn't make that payment, well, the interest is going to continue to accrue. And so your balance might go from 5,000 to say, I don't know, 5,350 or something. But for a lot of people, like that might be okay. And it would be very easy for someone to go like, well, times are tough or it's the holidays. I don't have a lot of money. Like I'll just let the interest accrue and then I'll tackle that balance next year. What happens is when you get a late fee, that motivates you because it's like it's a fee you can actually see there. And you're like, dang, I had to pay $30 extra because I didn't make a payment. More specifically, they don't want you to make the payment, let's say on the 10th, and then or you not make the payment on the 10th, and then you make it on the 25th or something like that. They kind of want to make sure you're making that payment because, which we'll get to, like they're paying interest on the money that they lent you. So they need you to make your payments not only sort of every month, but they need you to make them at a certain time and a certain date because all of the formulas that they've calculated about how much money they're going to make or potentially lose and the risk is all based on you making payments at a certain time of month and so forth, right? So late fees, again, just long story short, are made to motivate you not only to make your payments on time, but actually to make them on a certain specific date. And that's to ensure the whole process goes forward. And this is why some small side note is when you're in the real estate industry, you can also get, or if you're renting a property, you can also get late fees on that particular property. It's not that the landlord's trying to penalize you. It's just that if they know that if you are going to get a late fee, let's say in the fifth of the month, you will make that payment by the fifth of the month. If it's the seventh, you'll make that payment by the seventh, believe it or not. And we've done this. If a landlord waives it, that particular fee next month, you're more likely to then be late again because you think they're going to waive it again. So being stickler on late fees and really holding people to it is a very, very important part on the business side. I know as a consumer side, it's not very fun, but on the business side is extremely important. Not only do you have late fees, but they are impactful enough that it really gets people to get centered on it and that you don't necessarily ever waive those as a one-time occurrence or anything like that because it just sets a precedent that can continue on. And if you get into that, you can end up into some serious, serious problems or end up like where there's a default or you actually end up losing money as the person that's lending the money. So again, how do banks make money? For the most part, again, there's actually several ways they make money, but for the most part, the interest rate that they're charging you, and then any kind of annual fee, a loan fee, or late fees is what they're going to do. And we're specifically talking to lending. Of course, banks make other monies as like a local branch doing different things, CDs and things like that. But basically, the interest rate, the annual fees, and so forth. Okay. So how then do lenders lose money, right? And so that's probably the most important part because when you sit down at um, a bank is for the most part not lending you their own money, okay? And if the bank is potentially could lose money, it's not necessarily that they're losing their money. Well, this is the case, but they're also losing someone else's money. And so how do banks lose money? Well, they lose money if you take out a loan and then simply you don't pay it back. And that's probably still pretty self-explanatory. If you don't pay an annual fee or they don't get late fees and things like that, they don't lose money. They just don't make as much money. Where banks get into trouble is if they lend out, say, $10,000 so you can go put a deck in your backyard and you make a couple of years payments, let's say you paid it down to 8 grand and then you stop making payment. Well, they lost 8 grand because they lent out that money to you and they never got it back. And they maybe got a little bit of interest for that, but that doesn't necessarily mean that they didn't lose the full 8 grand. And I want to explain that to you. When you go, banks don't create money, right? So they don't print money. It's not like there's not like a little center in there where there's just it's endless, right? They have to accumulate money. And this is kind of the difference between big banks and small banks. And so, what most banks are wanting you to do is they go out to the community and they're trying to get deposits. Okay. And so, imagine if you have a rainy day fund. Let's say you have a 3 months rainy day fund. So, you have, I don't know, 6 grand in the account. If you go put your 6 grand into a savings account, so like you're just going to set it there, it's a rainy day fund, you're not going to touch it. The bank sees that, they want that, and they will reward you by paying you some sort of interest. Right now, as we film this in 2024, December 2024, they're paying about 4.5% interest back to you if you put the money in the savings account. So they're paying you. Well, how can the bank pay you by you putting your money in there? Well, they actually take that money and then they lend it out to other people. And so if they're paying you 4%, right? And let's say they're charging the other person 10% of the loan, the bank is making the 6% spread. And so when you're paying interest payments every single month, you're not necessarily paying the bank, let's say 10%. You're really paying the bank 6%, and the 4% goes to the person that actually deposited the money. And again, banks do other things. They take your deposits, they can use your deposits and leverage and get more money, and they do different things. So the whole bank's game is this process of saying, how much do I need to pay to incentivize people to give me their money or deposit money to my bank? Because I want to get as much deposits as I possibly can. The more money they have in deposits or in savings accounts within their bank, the more money they have the ability to lend out. And so if they pay, let's say, 0.5% of interest and the bank next door is paying 4%, well, they're probably not going to get a lot of deposits. So banks are kind of always competing of who's giving out the best savings rate. There's a multiple things that go into it. I don't want to bog you down with it. So besides just thinking about like, how do I get money in? Okay, so how do I attract enough people to put deposits? The bank then is also has to consider at what interest rate that they're going to give that money out to somebody. Okay. And they'll do that because they want to earn the maximum amount of money possible. So if the bank could lend you a loan at 80% interest rate, let me be honest with you, they would do it. Okay. There's some laws that says you can only have, certain rates and so forth, but they would charge the highest interest rate possible. That's what the bank wants to charge. The bank is also though in competition though with other banks, because if you're going to go get a loan and you know that bank A is charging 10%, but bank B is charging, let's say 18%. Well, clearly you're going to want to go get loans at the bank A that's charging low interest rate because it's going to cost you lower money. So banks are always surveying, again, not only how much do I get to pay out to get a deposit in, but then they're also looking out and they're saying, okay, I need to figure out what are other people charging interest rates, and we need to kind of be competitive to those particular people as well. So there's a threshold at which they really can't charge too much. But there's another thing that's underlined, and that's the default rate. Okay. And this where it gets very sticky for people. And this is where it can really frustrate people, or where all the frustration comes into as far as people getting approved, people getting denied, and so forth. Right. A bank's got to be looking at it. And just this is very, very important for you to understand. If you understand lending, the bank, as we said, the bank knows that they are going to have to pay, let's say, 4% out to the person that's giving them the money, right? And they know based on the market that they really can't charge more than, let's say this percent, 10%, let's say for this particular type of loan. So the max that they're going to make off of that particular loan is the 6% spread. And so let's say it's a $10,000 loan and they know they're only going to make, 6%, and they're going to do that, let's say each year. And let's say it's a 5-year loan. So you're talking, $600 a month. And then you're talking, over 5 years. So they're going to make 3 grand off the loan. Like they know what that profit is in the exact same way. If you were selling, the iPhone, it costs you $100 to make, you're going to sell it for 1,200, you're going to make $1,100 off it. Like they know that percentage, right? And so if banks know that, listen, I got to pay this guy in deposit, the savings guy, I got to pay them 4%. I can only charge 10%. So I'm only making 6%, and the 6% over 5 years on a $10,000 loan, just doing math in my head here, is let's say 3 grand. I'm only making the 3 grand. And so what happens is if they're giving out, and let's say they lend out, they're going to lend a bunch of $10,000 loans, right? So the bank's like, I'm going to make $3,000 off this loan and $3,000 off this loan and $3,000 off this loan and $3,000 off that loan and so forth, right? And so if they give out 10 loans that were all the same, they made $3,000 off each loan, they would make $30,000. So hopefully that makes sense to you. All right. If they're making $3,000 off each loan based on the interest rate, and they gave 10 loans out to 10 different people, at the end of 5 years, they would have made $30,000. Now, for the bank, they're like, that's pretty good, right? Now, of those 10 people, what if one of those people didn't pay the loan back, right? So they defaulted on the loan. And so what that would mean is they gave out 10,000, 10,000, 10,000, 10,000. They made 30,000, but somebody didn't pay the loan back. So they didn't make 30,000 because they didn't get $10,000 back from somebody, right? Well, now they only made 20 grand. Hopefully that makes sense to you, because the 30,000 profit they made, well, they're never getting the principal back on the one that they defaulted. So now it's only 20 grand. What if two people defaulted? Well, now they only made 10 grand. What if three people defaulted? Well, now they're break even. They made $0, right? And in that 3,000, they still had to pay for marketing. They still had to pay for the building, the employees, the crews, the pest control, the whatever, you name it, right? And so banks have this percentage where they can say, of this portfolio of loans, this bucket of loans, right? So of the 10 loans that were for $10,000 that we gave out to 10 individual people that were making $3,000 on each one of them, we are only allowed a default rate of one loan, so 10%. But it's going to be much less than that. We're only allowed a default rate of 0.4%, which means on all those 10 loans, like we can't even have one go bad. We have to have like one kind of go bad, but probably late after they've made, 4 years of payments or something like that, right? And so the bank knows those calculations. And so what is the bank's sole purpose? Like when you go in there and you sit across the bank person, you apply online, what the bank's looking at is they're looking at basically two things. They're looking for your ability to pay, right? And then your willingness to pay. Okay. And those are two actually completely different things. And they're doing that to basically put you into a bucket to decide what your default rate is going to be. Now, as an individual person, when we go in, we might say to a bank like, hey, I'm a really good risk. I know I'm not going to do it because I'm not going to fail, or I'm not going to default because of whatever, right? And so you see things as individually. The bank looks at things like simply just data points, okay? And so when a bank is underwriting, they're looking at stuff and they're saying, listen, we know that people with this credit score, with this debt to income ratio, um, and this type of loan for this many years has a default rate of X. And they know that because they do hundreds of thousands of loans, and the statistics are what the statistics are. Okay. Let's just wildly just put our thinking caps on, right, real quick, and just say, if we gave out somebody a loan and they had $1,000 coming in and the payment was $900, so they only had $100 left over each month, do you think the default rate on that loan is going to be high? And the answer to that is, of course, they don't have any other money to do anything else. If we gave somebody out a loan and they had $1,000 coming in and the loan was only $10, do you think they're more likely to pay that back? Of course, because the payment's low. So there's this thing called debt to income ratio that comes into play, that is extremely important in determining if they're willing to pay you money, which is the amount of debt that you have versus the income that you're coming in. So the more income that you have coming in, the easier it is to get an approval, especially for lower loan amounts, right? If you have a large amount of money coming in, say $10,000 a month, well, you can afford more of a payment. If you have only $5,000 coming in, then you can afford less of a payment, which is why it's hard. If you remember us going back and talking about how we make money and all that kind of stuff, is if you're only making 30 grand a year, well, it's going to be hard for you to get, say, a $2 million loan. But if you're making $2 million a year, it's a lot easier. Does that make sense? So the more money that you make, right, the less debt that you currently have in your name makes you look more appetizing to a particular lender. And so there's all strategies around this. Okay. The other thing a bank is looking for is let's go back real quick. Debt to income ratio is specifically different for different loan products. And I don't want to go into each one of them individually here for you, right? But I do want you to understand that debt to income ratio is like, say, for a mortgage, for example, when you go get a mortgage, and this is even different within the mortgage products, but let's use just blanket generic for my mortgage brokers out there. I have my license as well, so I understand mortgages, the ratios, and so forth. I'm doing this easy for the group. A bank might say, okay, you want this type of loan. It's going to require you have no more than 50% debt, all debt combined in accordance with your income. So if you have $5,000 coming in, you can only have 2,500 in payments out of all of your debt that's in your credit report. So that would be, and that would actually equal child support, alimony, car payments, student loans, anything that's listed in your credit report. The max payments are going to be 2,500, right? If it is over, you're not going to get that loan. They might also say, even though if you meet the threshold of 50%, right? They'll also say, well, in addition to that, your housing payment can't be more than 25% of your income that's coming in. So let's say you have an income of $10,000 coming in each month. Your housing payment won't be able to be more than 25% or 2,500 of that particular amount. And the total debt might not is more than 5,000, right? And so your mortgage might be 2,500, and then after your auto loans and student loans and other things, then your total debt is under 5,000. You're going to get approved for that loan. If your total payments are 60%, you're going to get declined for that loan. If the housing payment, the housing amount that you're looking for, the house is really expensive, so the mortgage payment would be higher based on the interest rate and the term and all that kind of good stuff. Let's say it's $3,000, right? Well, that's a problem because now you don't meet that ratio. So you can fail on both the housing ratio and both the whole debt ratio. Auto loans don't necessarily look at whole debt. They could look at something else. They might look at, well, they're looking definitely at whole debt, but they're not going to look at like what's your ratio of your car payment to everything else, right? The point is like every bank is different, every loan is different in how they look at debt to income ratio. The important part and what we need to understand is that debt to income ratio is a very, very important factor. So ultimately, what we were looking for is we want to get to, as a principle, we want to get as much money as possible and have as little debt as possible when we go look for a loan. Okay. And if you remember us talking about our credit and what's in a credit score, oddly enough, what is credit utilization? Credit utilization, right, is how much credit is available to you versus the ratio of what you're using. But if you used up a lot of your debt, that can actually lower your credit score. Well, if you're using up a lot of your debt, and the debt that you get is based on your debt to income ratio, then it makes sense that as you sort of max that out, you're getting a lot more debt. So you're getting a lot more debt to income. Hopefully I'm making this make sense. So you have a credit card, let's say it's 10,000. If you've only charged 1,000 on it, your credit utilization, the amount of credit that's available to you versus what you're using is $1,000. So it's 10%. Well, that credit that you got, the $10,000 loan that you got, that was based on your debt to income ratio. And so they wouldn't have given you the $10,000 loan if you couldn't afford it, right? But you're only using 1,000 of it. So it looks really good. So your credit score is really, really good. Probably, I don't know, 750, 800 credit score. But if you maxed out the credit card for 10,000, you have a lot more debt in your name. Because you have a lot more debt in your name, your debt to income ratio would actually be larger, or it would be a bigger, right? Because you have a $10,000 loan. The payments can be higher. It's going to take up more of your credit or more of your debt. So you're going to be higher risk because you have more debt in comparison to your income. And so your credit score will go down. So those are kind of combining. I hope that makes sense to you. That was probably very complex for somebody that doesn't know anything about credit, but that's so just kind of linking some of those things together. And so the next one is your willingness to pay. Okay. And so your willingness to pay is different. And so if I say, hey, look, you got $10,000 coming in, yeah, you got a little mortgage, 2,500, you could definitely take on another, I don't know, $500 payment or whatever. Like your ratios are good, income's good, all of that kind of stuff. However, just because you have your income doesn't necessarily mean you're going to make the payment. Now, you might be thinking to yourself, like, that's crazy. Like, why would you, if you have so much income, like, how do you not make your payments so you have the money to do so? Well, because not everyone spends money in the same way, right? And so somebody could be looking and saying, well, this person has a lot of money. But if they're taking their, or they're doing Uber Eats every weekend, they're going partying every weekend, they're getting, Super Bowl tickets for 2 grand or whatever, like they could be spending all of their income where they actually don't have enough money to make payments. Side note, we have a tenant that just moved in, and like, so we know their financial situation, right? And in speaking to them, they were like, well, I don't have a whole lot of money. Like the rents, you're about right there. And we looked at their income and we're like, oh, they just kind of meet their requirements, but they got a good pay history and stuff like that. Like we'll go ahead and approve them. Long story short, like we knew that they were kind of paycheck to paycheck, didn't have tons of money. I go over to the property because I'm actually visiting other properties in the area and I happen to drive by. And the tenants spent, they have a big Christmas tree out front that they added. They put lights all in the whole house. They bought like all these ornaments for the front of the house. And I thought to myself, I'm like, well, they must have spent at least $400, $500 on all these Christmas decorations. But I know they don't even necessarily like they are just kind of skimming by just to be able to make all the ends meet. So where did the $500 come from? They must put it on a credit card. Maybe it was gifts. I don't know. But the point is like people will spend, or like we just know in a personal life, like if you're watching this, you probably know some friends that bought, a nice watch or a car that's probably too expensive, or they went and got a new purse, and you might be thinking like, how do they have the money for that? Like I know what they make or whatever. That's people spending too much. So you can have bad spending habits, earn and consume lifestyle, bad spending habits. So your debt to income ratios could be good because you're not necessarily taking out debt, you're just spending all your money in crap. And so what that means is that maybe the couple of payments that you do have, you can actually not make those payments and you can fall behind. And so credit willingness to pay is all actually your credit, pay your credit pay history. Okay. Going back to lending, and I want to talk to you a little bit like kind of buckets of lending, how interest rates work and so forth. We just went over a little bit, but I want to go over it in a little bit different of a way is when you look at your credit score, usually again, 800s, these are, just kind of general guidelines, but let's call it 750 to 850. Like there's no mistakes, no whatever. If you're like in the high 600s, low 700s, you generally have perfect credit. You just kind of have a high credit utilization. Maybe you having too many inquiries and things like that. When you start getting the lower 600s into the high 500s, generally you have some mistakes there. A couple late payments, you might have a small medical collections and so forth. And so you get put into these credit buckets of like subprime lending and then prime lending. Okay. This is very important for you guys to understand. And this was my business here for like 15 years or so that I was telling you about. Believe it or not, when you go to a lender, lenders specialize in very specific things. Like if I said to you, hey, I was playing football, I tweaked my knee, I need to go to a doctor. Most of us get it. Like, what doctor would I go to? Like, I'm not going to go to, an ear, nose, and throat doctor, or I'm not going to go to a radiologist, or I'm not going to go to, the ultrasound tech or whatever, like whatever the doctor was, the ultrasound, like there's different doctors for kind of different specialties, right? If I tweaked my knee, it's different than potentially if I have a sore throat, right? A different particular doctor. They're going to do different x-rays, do different things. So there's specialties. Lending is exactly the exact same way. There are things called there's things called subprime loans and prime loans, but there are also things called subprime lenders and then I could say prime lenders. Okay. And what I mean by that is there were banks that we used to work with that would say, I will approve anybody that fits this criteria. It's got to be 740 above credit. They got to have at least $100,000 in savings or an account, 401k, IRA, something that get liquid. They need to, and they can only be using the loan for home improvements or like, and they listed a couple of things. That was their criteria. Gave out really, really great, amazing interest rates, 10-year terms, like best terms, best interest rates in the industry. Amazing, amazing, amazing lender, right? Very specific what they gave. The next lender would say, well, I'm willing to do a little bit lower than that. I'll do really 680 to, above, 680 above or whatever. My rates are going to be kind of mid-range. There's some decent rates, but like kind of a mid-range or whatever. And we'll give out for, debt consolidation, for home improvements, if you just want to take a vacation, if you got to pay your taxes, like their criteria was different, right? And then you'd get into subprime lenders, where a subprime lender would say, well, I'm really at 580 credit score and above. We're really doing things for people that are, lawsuits, need to pay taxes, again, debt consolidation, medical bills, like they would lend out for certain things, right? And so if you were of really, really great credit, so your 800 credit score, you could apply to the subprime lender, okay? And you would get an approval. However, you wouldn't like the interest rate. If you were a subprime person, so you had like a 600 credit score and you applied to the prime person, you would get a decline. That probably makes sense to most people because the really great person would not approve. The bank with it only like for prime people, only approve prime people. So only great interest rates or great credit scores. The subprime person will prove anybody that's above. But as a prime person, you don't want to apply to the person or the bank that is a subprime lender because their specialty is subprime and they kind of only loan those types of loans. So they don't give out much of a higher approval. The interest rates are really high. They probably have a base interest rate, and that's it. So that one person, let's say that has an 800 credit score, making $200,000 a year, wants to put a deck in their backyard, so needs 30 grand. They go apply to the prime lender. They're getting 6%, 10-year loan, $30,000. Great loan, right? If they apply to the subprime lender, they're going to get a $10,000 loan at 17%. And you might be thinking like, and the person that goes applies there is like, what? That's crazy. Like, I have great credit. How can you give me an interest rate that loan or such bad terms? It's because you went to the wrong lender. Okay. So my whole business that we did for a while was people would come in, they would basically just say, like, what lender should I go to? This is my credit, this is my income, this is my debt to income. And we would basically analyze all the metrics. And then we would say, oh, based on what you're looking for in this, whatever, this is a good lender. Now, there's actually companies that sort of do that right now. I'm not going to name drop them because our website sort of does that still a little bit. But like there are companies out there that still do that particular thing. But the point is, I want you to understand is lenders have certain categories that they lend to. And if you go to the wrong one, you can get unfavorable terms or unfavorable outcomes simply for no other reason than you went to the wrong place. And if you're in bad credit, you went to a prime lender, you got declined. That doesn't mean you can't get a loan. That just means you went to the wrong place. Where it really runs into frustration as an industry, and it is what it is if you're subprime, so you need to go to a subprime lender and you don't know who that is. And so you just go out and you just start applying to a bunch of different places. Remember, you can get a bunch of inquiries on your credit, and those inquiries are hard pulls. We talked about that earlier. And as you get those inquiries, your score will drop. But actually, you can just start getting declined simply because you have too many inquiries on your credit. Okay. And so now you go and you want to, go and try to get a loan. You find the right lender, and that lender says, well, you got too many inquiries. Like, it looks like you're taking out multiple loans, and I don't want to approve you simply because you have too many inquiries. That's really dumb. The point is like, I want you to understand is that when you go get lending, it's very important that you understand the bank that you're going to, what type of clients that they approve, the type of loans that they offer, and so forth. The downside, and this is where government comes along, is you can't walk into a bank. So don't do this. You can't walk into a bank and say, hey, my credit score is this, this, and this, and this. Do you approve people like me? Okay. And the reason why you can't do that is because the bank can only say to you, if you're looking for a loan, I can put in I can give you an application, right? Two things banks do that are not good, but it is what it is. If they were able to say, hey, we only accept this type of person, credit, income, whatever, there's a very fine line to that person saying, well, we only accept this type of person, race, gender, location, zip code, whatever that you came from. That's redlining. That's legal, right? And so what banks do is they don't even get anywhere close to it. They don't even want to be accused of saying, well, because you can imagine someone comes in, the person, the loan officer doesn't like them based on whatever reason, characteristics that they have, race, gender, sex, whatever. And they go, well, yeah, we wouldn't accept your credit. Well, how do you know that, right? They could just be saying that because they don't want to lend to you because of those other characteristics. So banks can't do that. So banks will also, you can say, yeah, we do unsecured financing. Sure, absolutely. You want to take an application? I'll take an application. The downside is too, is that oftentimes banks will take an application simply so they can get your data. Let's just say data, and so they can sell you into other products. Okay. And so let's say you are coming in, you drive up a fancy car, they see you come in, nice suit and all that kind of stuff. And you're like, I want to do a home equity loan, or I want to do an unsecured loan because I want to build a deck in my backyard. And I need $50,000. The bank could be thinking, you know what? We would never do that loan. However, I'll give you an application because if I can pull your credit, maybe I can see, oh, look, I can kind of see your finances. I know what your income is. I probably know where you work. I know what all your credit report is. I know your home, whatever. Maybe I could figure out that, oh, this is where your house is. This is the balance on your mortgage. I can kind of see what the value of that house is just by a simple Zillow lookup. I know what the balance is. I know there's equity there. Maybe I can push you into a home equity line. So I can resell you into something else. That sucks. That's what when banks do. That's really dumb, right? But it does. It's business, right? So you have to be very careful because each inquiry is very, 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 very important. And so just real quick, we covered this before, but so what happens? You go to a bank, you submit an application, you walk in the bank, submit the application online or whatever. They go to FICO, the FICO goes to get your credit report information. They come with a score, they give it back to the bank, and the bank makes the determination. Remember, a bank might say to you, based on your credit score, this bank will say, I approve anybody that's a 740 and above credit, right? The bucket that they have is we want 740 credit, better credit people. And then, you got to have income and so forth. Just because you have a good credit score doesn't mean you're going to get approved. What that does, again, it's a general grading that says, of the people that we approve, in general, have this particular credit score. Okay. I missed one part. If I go back, we'll go back to a couple slides. I missed one part. If the reason why there's subprime lenders and prime lenders, remember when I was telling you about how banks lose money, right? And so a subprime lender, the data that they have on default rates, they know that if they lend $10,000, let's say for 2-year loan at a 22% or 18% interest rate, whatever it is, really high interest rate, to a person with this credit score with only one late payment from 2 years ago, like there's very specific criteria and data that they know if they do this, again, they're gonna pay 4% to the depositor. If they lend it out, say for 20%, they're gonna make 16% on that loan. And based on that loan, all the loans that they give out, remember we talked about, they will make enough money that even though there's going to be a high default rate in that population, and there's going to be a higher default rate because those people have a higher debt to income ratio, they have a lower credit score, they've shown bad things in the past, so they're probably going to show bad things in the future. Like people with lower credit scores, it is what it is, have a higher default rate. That's why they have a lower credit scores because they keep defaulting or making mistakes. But the interest rate that they charge is large enough that when their default rate, even though it's a little bit higher, they'll still be okay and they'll be in business and they'll make money. The prime credit person, right, knows I'm getting 4%. I'm giving out this loan at 6%. And so I'm only making 2% on the spread. And so if I give out those loans, I have to have zero default rate. And they will generally have a zero default rate if they're only lending to people with 800 credit scores with really, really great income, with long job stabilities, to doctors and physicians and things like that. And those people that have a tremendous amount of money in the bank, because if there was a default on the loan, they know that this person has $100,000, whatever, that they can go after to go take that money to recoup their money, right? And so banks are very specific. The reason why they stick in those buckets and they only do one another is because you have to be a master at how you're lending and the data you're lending and who you're lending to and then whatever, because you cannot have high default rates. Okay. And so that's why there's just different buckets. And that's why if you go to one or another, you're just kind of like round peg in a square hole or whatever. Like it just doesn't fit, doesn't work out well because they're not going to just do the one exception because they don't have enough data behind it to do the one exception. And a bank may not necessarily have the resources to do all different, to do prime and prime and subprime. I mean, you need a lot of loans, a lot of data to make sure that you were getting everything correct. Okay. So banks generally don't necessarily do that. So what are banks again looking for? So they're looking for then if your credit score, let's say you have a good credit score, so it's a 740 and above, they're looking for your again your ability to pay. And the ratios are going to be different. They're all based on usually just mostly just the interest rate, but your ability to pay is going to be the amount of money that you have coming in from your check versus what that new payment's going to be. Okay. And also in accordance with all the other things that you're making. So they're going to look and they're going to say, how much is your rent? How much is your mortgage? How much is your auto loan? How much are your all your other debts? And they're going to say, if I add this payment into it, how much is your debt could you have? Do I think that you can make that payment based on what they know of all the other people, right? And believe it or not, there's certain ratios that people go get into. Um, there's certain ratios that people get into that they know that most people spend about this much on this and this much on this. Like when we do budgets, we all kind of have the same things. Okay. The next thing they're going to be looking for again is your willingness to pay. Okay. And so the idea here is if you didn't pay someone else, you're likely probably not going to pay the current person or you're not going to pay the new bank, right? And so remember when you're going to your credit report and we said we're going to go through the trade lines. This is when they say, hey, the credit score looks good. Seems like this is going to be the right person. The income looks good. Let's now go into the credit report. Let's add up all of their debt to figure out their debt to income ratio. And let's look at the individual trade lines, right? And so what they're going to be looking at, if I go here, I can look and I say, okay, well, this person's had an account for 2014, 15, 16, 17. So, about 4.5 years, they've been making payments or this account has been on time every single month, month over month, month over month. Okay. Now, this loan is a student loan. Okay. So if you have a student loan, they might look and say, well, they're paying their student loans, but they're really asking for a credit card. Have they paid other credit cards? And we're going to get into that in a second. But the banks, again, want to see you like you pay a like loan that you're going to give to them, right? Because a lot of people will pay their mortgage, but maybe not necessarily a credit card, right? So if you're paying your mortgage on time and they see that, that's a good indicator, but it's not necessarily as good as if you had a mortgage and a couple of credit cards. So hopefully that makes sense. Um, on here, just again, they can look at the total amount of balances you've ever had. Did you pay it off? So let's say you wanted, in this particular case, the balance on this particular card is 2,700. The high balance that they've ever had, right, is this $10,000. So this person has taken out a loan for 10,000 and they've been paying off for several years, and now it's 2,700. So they're actually paying down the balance and the interest or whatever. A credit card would kind of show something different, but it also shows the credit limit. So you might see something that goes, oh, this person has a credit limit of 20,000. They've actually maxed out that card. They've paid, they've taken out 18,000 and they've paid it all the way off. That's a really, really, really good indicator. On a side note, and we'll get into more of this later, is if you're applying for a $5,000 card and you have a $20,000 credit card already and there's no balance on it, it's actually they can actually decline you because they're like, you already have a credit card. Why are you getting this other one? Because what they're worried about is you doing something called loan stacking, which they're thinking, oh, maybe you're trying to do a large purchase. You're going to max out the 20 and the 5. So they're going to kind of look at all of that. So, but it's not just, again, your willingness to pay is obviously just seeing those on-time payments. But remember, it's also the length of your credit history. And so this is why if you have a long credit history with a lot of payments, your credit score is a lot higher. Again, that's an indication. If someone has multiple credit cards, but they only have it for a couple of months, your score is going to be lower. Again, hopefully this is all making sense. So a bank that says we loaned a 740 and above credit, they can probably tell you, well, I think I'm probably going to see a mortgage that's been paid for several years. I'm going to see a couple of credit cards that have probably been open 4 or 5 years with on-time payments. Like they kind of know what they're going to see, because if they open it up and there was just one card with one payment, you're generally not going to have, like, say, a 708 credit score, because that's not how the scoring model is an indication of what they're going to see. But again, they're double checking it. So if I go into credit history, we did the slide earlier, but this person's been paying in 16, 17, and then a little bit in 18. So this has a 2.5 year history. This one has a 4.5 year history. So if these two people were applying they may both get approved. The person with 4.5 years history is going to get a little bit better of an interest rate because they seem less risk. And again, those algorithms that they're putting the data into literally say if people has a credit card and they've been paying it for 6 years or 16 years or 20 years, they've never missed a payment, their default rate is this. If someone just started out, they've only been paying on a credit card for a year and a half, their default rate is this. And so there's all of those that are all of those that are in there. So as we talked about, so they're looking at your ability to pay. You have all the income, great. Are you willing to pay? You go in there, you have all good on-time payments. They're looking for you to have, again, multiple different types of accounts. I can express to you enough that if you just have a mortgage and no credit cards or no auto loans, if you go get a credit card, you're probably getting approval, but you're not going to get a really great credit card approval. Okay. If you've had a mortgage, and you have like let's say two credit cards and one's a $20,000 balance and one's $15,000 balance, and both of those like you've made on-time payments and you did that for several years, you're more likely then to go get another credit card with no problem whatsoever because you have that long history. If you've had an auto loan before and you've taken and you paid it off, you're more likely to go get another auto loan. On the flip side, remember this, because this has actually happened to me. Oftentimes, what I would do is because even though I teach go get loans, I don't like to pay interest on auto loans. Okay. So I've made the personal choice, it's not what you necessarily have to do, but I made the personal choice that I've gone into like car dealerships or whatever to go get a loan. And I said, listen, I know the car dealership makes money off the loan. And so I know the car dealership is willing to give me a better deal on the car because let's say they make 3 grand on selling me the car. They're also going to make maybe another 1,500 or so in selling me the loan to pay for the car. Okay. When you finance through a dealership, oftentimes they're making a little bit of money on that. So I'll go in, and that's why when you're talking to a dealership, they'll often say to you, are you going to buy cash? Is it check? Is it credit? What is it? Or whatever. They'll ask you if you say, oh, I'm trying to get financing. They'll try to get you in with that financing person in-house because if you're paying a 6% interest rate, they might be getting it actually at like say 5% from the bank. So they're earning a little bit extra off that. So what I do is I'll go in and I negotiate my car price. I'll get the financing with that particular bank. And then once I get it, I'll make a couple of payments for 2 or 3 months and then I just pay it off, right? It's just like I bought cash. That gives me a lower price point at the car. I got the financing, which I just paid a little bit of interest, but not enough to compensate for what I got from the car. And I just pay it off. Well, if a bank goes in, they look at your credit and they go, yeah, you've had 3 or 4 cars, and every time you take out a car, you pay it off in 3 months. The bank will actually decline you from that because they're going to be like, we don't want to waste our time going through the whole process, underwriting, give you the money, whatever. You're just going to pay it off for 3 months. Or they might say, well, I'm going to give you an approval, but I'm going to put a prepayment penalty on there for a year and a half. You have to keep that for at least a year and a half before you pay it off, which I think is super interesting. And that's happened to me before. Specifically, when I've gone and gotten higher priced vehicles, supercars and things like that, and the negotiation of that is actually pretty significant, especially when you're talking about lenders. The discounts and things that you can get is pretty significant. And I've done that with every single one of my car. I now have learned to just kind of keep it a couple of months to do that. So the point is that the lenders will look at the type of loans and how you treated those particular loans as well, because that's going to go into the calculation. It does cost the bank money to just do the paperwork and process and all that kind of stuff, right? And like an auto loan dealer doesn't, or an auto loan lender doesn't want to pay a dealer a certain amount of money and then you pay. They can actually lose money because they paid the dealer, let's say a certain percentage for bringing them the loan, but then you paid it off. They didn't make enough of interest and they lost money in the deal. They don't want to do that. So they're going to look at, do you have a mortgage? Do you have an auto loan? Do you have credit cards? Do you have student loans? Have you been paying all those on time? A good rule of thumb is just pay everything you have on time, but just understand that if you've never had a certain account before, if you've never had a balance like that before, it'll be harder for you to get the loan. So if you've only had $1,000 credit card balance and you want a $10,000 credit card balance, that might be difficult. If you had a $40,000 vehicle and you paid that off, that can help you out in actually getting the credit card because you've carried a large, substantial payment. Let me clarify that for you a little bit. If I have a $40,000 vehicle loan, let's say it might be, $600 payment. If I get a $10,000 credit card, the minimum payment might be $400. If the bank sees that you handled a $600 payment based on your income and paid that for several years and paid it off, they're going to go, well, he's made this payment perfectly fine. That was okay. He probably can handle the 400. It's less. I'll give him the approval. So all of that is in reference. So, and another thing, the last thing is oddly enough, some banks simply just say, if like who else took a chance on you. So, and I just put this like if you're good enough for them, you're good enough for us. I'm not going to get into the specifics here. I won't name names in this video because things will change. But there are places that you can go right now that if you walk in, you go, I want to apply for a card. They'll say, do you have another credit card? And if you say yes, they'll automatically approve you because they don't. These are smaller companies or like third party kind of thing. Think like a not these companies, but like a Best Buy or like a Victoria's Secret or like those like department stores and stuff, they don't have the big underwriting and all of that. And they basically are just going to go, if like Discover's willing to give you a card for 2 grand, like we'll give you one for 500-600 bucks, like whatever. But there are other places that will say, and we used to do this when I was in the underwriting side of a company I worked for, is they would say, what type of accounts do they have? An American Express card is a lot harder to get approval for than, say, a student loan Capital One card. Okay. And so what they would look at is they would say, well, this person has a credit card with an American Express with a $20,000 balance. I'll give them a $5,000 unsecured loan all day long. Like American Express can give them 25. I'll do this all day long. And so there are certain banks out there that just simply by you having certain types of cards, if you have American Express Platinum, if it's listed, they can see those types of things. It'll actually get you approvals for different things simply because you have a card. Actually, if you have cards, there's one thing that banks actually do. If you ever get the solicitations in the mail, what they're actually doing is they're pulling data. They're buying your data from like Equifax or Experian, and they're going through and they're looking and they're going, oh, like, hey, this person they live here. This is their mortgage balance. There's an equity line. Let me send them an option to refinance their house. Oh, this person has a lot of credit card debt. Let me send them an option to consolidate their credit card. Oh, this person has an American Express, whatever. Let me send them a personal loan option. Like they'll use the data that they have to figure out what offers they want to send you to try to track that type of business. So not only do you want a mix of accounts, so mortgage, a credit card, an unsecured loan, student loans, and making on payments to all of those for a very, very extended, long period of time. You want to have a mix of different providers for that, right? So maybe you have a small credit union on the auto loan. Maybe you have an American Express, a Discover, and a Visa card, not just 3 Visa cards. You want to have you want to have just different types of accounts. You do that, you'll have a credit score like I do of 850. So maybe one day we'll in a video down. If you go to our website, medibi.com, we had a lot of like extra stuff that's in there. Maybe we'll go through my credit report. Ideally, and you can see kind of just this in practice and sort of how all that works. So again, just kind of recap, and then we're moving on from this. One, how much you're requesting. Does your FICO score, your credit history fit the type of loan? They do subprime loans. Like, are you as a borrower, or do you match their particular bucket? If you're looking for $10,000 loan and they offer only $5,000 loans, they might just decline you outright because they don't even do the loans that you're looking for. Based on your credit score, they're going to look at what rate, what bucket you're going to be in. And if you're in that bucket, so people with 600 credit scores are going to have this particular interest rate based on that particular interest rate. And they know they're going to give you a two-year term. So if they know that you're in this bucket, the max you could get based on your income would be a $6,000 loan at this interest rate, this bucket. They're going to be able to determine if you can kind of afford that loan and so forth. So, and I guess we didn't cover that entirely, but it sucks too as well. But if you have really great credit, you get a lower interest rate, which means you can get higher money at a lower interest rate. Your payment is X. But if you take out a higher interest rate, you can actually have lower money. Your payment would still be the exact same. So sometimes credit is not necessarily even about you getting approval, but allows you to get more money, not because you're just getting more money because you have a higher risk, but because you have a lower interest rate, which means your payment's going to be lower, which means that you can get a larger loan. So hopefully that makes sense to you. I mean, credit like literally is in every part of it. So we actually didn't cover this too much, but like how long you've been at your job, actually matters as far as like your ability to pay back the loan. So let's say you have a really good income, but you haven't been at your job too long, that can affect things. So let's say you're a sales guy and you've been in a job for 6 months. Well, because you're in sales, that could fluctuate. The income could be unstable. They could discount your credit. They could discount your income a little bit because they don't think that you may necessarily always make that. If you've been in a job at a very short period of time, while you had the income, what if you lose your job? You really haven't even established yourself yet. So again, the worst case scenario is someone that just has an offer letter. That person is going to make money. That's not as good as the person that's maybe been at their job for 20 years as an engineer and they're making the same amount of income and getting steadily increases every single year. Obviously, you want to lend to the person that has a really good income and has been making that income at the same job for as long as possible, right? So all of that matters. And then again, how have you managed your particular debt is a big one. So have you had large credit card limits before? So do you have a $10,000 credit card limit? Have you charged that card a $10,000 and then paid it off? If you have a $10,000 limit, did you just use 1,000 of it and now you want, more credit for some particular reason? But how did you use that debt? And then have you been able to sort of pay a mortgage, a student loan, an auto loan, a credit card? Are you able to pay sort of all those at all different times? Are you able to juggle all of that? Long story short, if you have a really great income and you have just a little bit of credit, and of the credit that you have, you've had it for a long period of time. So think about you have a mortgage for 10, 15 years. Maybe you have an auto loan you took a 5 or 6 year loan, and then maybe you took another one. So you had two auto loans that have been, nice history for, 5, 10 years of auto loans. And then you've had credit cards for 7 or 8 years that have kind of substantial balances. You've been at your job for 2, 3, 4, 5 years. That is going to be a really good risk because they're going to say you have great income, you've been at your job, it looks very stable, you've had all these other debts, you're making all your payments on time, you have a nice mix, you have different providers. That's what you're looking for. And so if we know that, and this is going to segue into the next lesson, but if we know that, now we know, okay, so this is what the bank is looking for, and they're doing all of that because they just are worried about you not paying back the loan, and they're doing that based on the buckets that they can put you in based on how they lend money. If you know that, now let's go and let's talk about how do we get to $40,000 credit card limits with American Express, with some of the best providers in the industry. How do we get these types of loan products? Because you just don't start out. So how do you build up into that? How can you really design yourself and just do small things, even at the age of like 16, 17 years old, before you even really have a credit score? How can you do some of these things to establish yourself so that when you really need credit to make big moves, you have it really well established? I think I covered this before, but the number one thing that is terrible, terrible for you to do is to make really bad mistakes in your 20s. That then when you go into your 30s, when you need credit, it's a big downplay. When we get into investing, this is going to be so important. But like, guys, an interest rate of 3% versus 12% makes some deals not doable. Okay. If you have bad credit, if you don't have stable income, if you do these mistakes, and this is why we have the course, if you do those things wrong in the beginning, it makes it very harder to do the other part and almost impossible. If you do really great work up front, the back half, it's so much easier. Into where you're like, people are like, how did you get, I was just talking to somebody the other day, like, how did you get that mortgage, this property so low? Well, my interest rate's 2.9%. How do you do that and that works? Well, I don't pay any interest rate on my credit cards. And like, so like, if you have the ability, like people will say, oh, it's privilege, whatever. No, it's you doing the right things leads to really great situations, puts you in a great opportunity, or allows you to take those opportunities as they present themselves and run with them. If you run into opportunities and you have no money saved to deploy capital, or you deploy capital if you need to get leverage to get more, and you haven't built all those things up, you are simply never going to build generational wealth. One of the key reasons and the biggest missing part, and why I'm teaching this course the 13th grade, and what people are missing, and this comes specifically from my experience that I have in the lending industry and then seeing the wealth building with leverage, is that I can talk to you all day long and we're going to get into some really, really cool stuff. And you're going to be like, no way is that even possible. And what I'm tell you is that it is not possible if you don't do these pieces. What I noticed from all the books and all the financial classes, even the stuff you can learn in school, what they don't teach you is the combination of how credit is so instrumental, how the way you pick a job and the job you take is so instrumental, because your job and the income with the credit score is what gives you the ability to get leverage. And that ability to get leverage and then invest it is the key. If you choose the wrong jobs and you have good credit, you can still be hard to get leverage. If you have the right job but bad credit, still hard to get jobs. You need like the right career, the right length of career, the right income. You need all of those things. When I say that my kids will do completely different than the average individual, because what they learn, experience, and otherwise, like their circle of influence is mom and I, and who we put them around, the jobs they choose, the things they go into are going to be completely different. My kids will have a 800 credit score and be choosing a job that I know when they go into a lender, the bank's going to be like absolutely all day long. Then they can do even the grander things, which is not only just getting the financing so easily, but really developing deep relationships with the banks and the community that's around them, that they can then go get a financing that's specific to them with underwriting guidelines that are given to no one else. And where you get loan officers and banks and community banks that walk into them saying, I'm giving you financing. Like we just secured financing, $2.7 million on a deal. The lender was like, I'm doing it because I believe in you. Wasn't credit, wasn't income, wasn't whatever. But I didn't get to that point until we had done all the other things. Okay. What's missing out there and what people get missing is there's a lot of really great information on like how to invest in the stock market, how to do day trading, how to do fix and flips, how to do an Amazon business store, how to whatever. There's all these different things. There's things like how to remove things off your credit report. There's all those kind of gurus that are out there. Why do you need to learn how to do an Amazon business store if you can't get the two or $300,000 you need to really scale that business? Hopefully that makes sense, right? You need to get this section correctly. So if any of it didn't make any sense, go back and rewatch it. It's in all of these. You can always reach out to us, ask questions. We do lives and other things out there on YouTube and all the other socials. Jump into those to really, really understand how all this works. You have to master this, okay? Credit, how you make money with investing, and then investing along with taxes. It's the combination of those things that are going to bring you from nothing to something in a very short period of time. Let's go learn how to build an amazing credit score on the next lesson.